Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man all the way from Philadelphia, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
And I think we need the disclaimer up there for everyone to see.
Yeah.
There we go.
Yep. So before we get started, everyone, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And with that, let's get started. And as a reminder to everyone that we're not going to have a show for tomorrow and Friday. Will's going away, family vacation. So we will be back Monday. Correct, Will?
Perfect. Yep. And everyone have a, if I forget at the end, have a great Thanksgiving. I will be in Orlando, which should be fun.
Nice. Send pictures.
I will.
So what we'll do, if you guys are joining us for the first time, if you have questions with Market Chameleon tools, data analytics, strategies, you'll put those questions on the live chat on YouTube. Will's watching it, he'll read them back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. When you click on that link, it takes you over to Zoom. When you're in Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. Once we let you in, everybody will be able to hear you. You could ask your question directly. While we're waiting for questions to come in, what we'll do is take a look at the pre-market report, see what's trading in pre-market hours. Then I had some questions regarding one of our reports. It's the synthetic discount screener. Maybe I'll take a look at that today, kind of go over it with you guys. Also, we could take a look at some strategies, strategy setups. When would you use a particular strategy? It's a ratio spread, like a 1:2 ratio spread. We could set that up on the options chain, take a look at the payout diagram, and talk about what type of situations this strategy could be applied to, how to evaluate it. So that's what we have on deck today. I don't know if we'll be able to cover everything today. If we do have questions come in, Will, though, let me know, and I'm going to try to answer the questions first.
Perfect.
So let's start with the pre-market report. These are stocks trading in pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. When I come down here, I see 65 stocks made our percentage gainers list, 40 on the decliners. From this perspective, we look like we're set up for a slightly more bullish bias at the open. We're going to filter down this list to S&P 500 companies. We want to see what's going on in those companies. If we take out all the ETFs, leverage products, closed-end funds, preferreds, rights, all those, let's take them out, focus on the S&P 500 stocks. To do that, I'm going to use a filter up here, an ETF, drop it down. You could see a list of ETFs to select from. I'm going to take the SPY ETF, which is the S&P 500 ETF. By clicking on it, what we're going to see is the list below. Let me see. I have to refresh my screen, I think. Hold on. I had this up for a while. Let me refresh my screen. Let's say SPY, S&P 500 ETF. What will happen is the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. Here we see 15 stocks made our percentage gainers list, 5 on the decliners. Again, this looks like a more bullish bias at the open from this perspective. Let me see if we have no questions right now. Will, what I could do is move on, look at the synthetic long stock screener. And if we have questions come in, let me know.
Perfect.
All right. So we haven't gone to this screener in a while, and I'm going to take a look here. So I'm on a synthetic long stock, okay? And what this does is it takes a look at the options in the stock, and it says, okay, if I went out there and created a synthetic long, if I took a strike, so let's see an AMC, right? If I looked at a particular strike, here's the 4 strike, stock $7.27. If I look at the 4 strike in particular expiration, this one's March 17th. And if I buy the call on the 4 strike on the offer, and I sell the put on the bid, synthetically, we created a long stock. It's going to behave like a long stock, 1 for 1 going up, 1 for 1 going down. All right. So in the options, we created a synthetic long. And usually, you know, it's gonna be above the stock price, because creating a synthetic long with options, there's a cost of carry, right? Because if I buy a call, sell a put, you know, I'm basically foregoing having to pay the entire $4. So I save on interest, whatever interest I earn in the bank or whatever. So there's a cost of carry to it. And if it doesn't pay any dividends, let's take out dividends for now, because the dividends will affect it, or spin-offs or anything. But if it doesn't have any kind of other corporate action, because of the cost of carry, you'll see that that synthetic will trade above the stock price, 692. I'm sorry, the stock price, 727. But this is looking for those synthetics that are a discount. So what do I mean by that? If we did that strategy, bought the call, sold the put, it's synthetically like buying the stock at $6.92, which is below the stock price, 727. Okay, so 4.7% below. Here, let me see if I could show that to you in an options chain. By clicking on it, it's going to take us to the options chain, and then set up the strategy. So over here, look, here's the 4 strike, March 23rd. Here's the 4 strike. Well, if I buy it for $3.55, I have a call, right? Going up, it eventually will act like 1 for 1, but there's time premium in there. But if I sell the put, right, at 63 cents. So see here, buying the call, 4 strike, 355, selling the put, 4 strike, 63 cents. Let's look at that strategy, and that will cost us $2.92, right? So we're paying $2.92 above the 4 strike. So if I had $2.92 to 4, that's $6.92. Synthetically, that's where we're buying the stock. But the stock is 726, right? 726 versus 692. So there's a discount in the synthetic market. And you could see here, that's the spot price, 726. So what will happen is, if at expiration, the stock is exactly here at $7.26, right? Well, what will happen is my put will expire worthless. My call will get exercised, and I will be long stock, right, at expiration, long stock at $4, the strike price, plus whatever it cost me, $2.92. So $4 plus $2.92, $6.92. So if the stock, it cost me $6.92, and at expiration I could sell it at $7.26, basically that would result in a profit, right? What we said was 4%. But why can't we arb this? Why can't we just sell short the stock right now, 726? Well, that's probably because it's hard to borrow. This is why this exists. The synthetic market is telling us that to short the stock, we need to borrow it from somebody. And to borrow it from somebody, they're going to charge us a fee. And the fee is probably somewhere, around what this is, telling us or more, right? So really this fee is probably being reflected what a broker dealer would be charged. So there's no way for us really to arbitrage, right? We cannot convert it realistically into a arbitrage situation, because as a retail customer, there's no way somebody's going to let us borrow it for free, or, borrow it probably even for at a cost enough to make this an arb, because the broker dealer will arb it. But if you are bullish on AMC, if you're like, well, I don't care about that arb, that's not what I'm interested in. If I'm bullish on AMC and I think that the stock's going to go higher, and I'm willing to hold the stock from, now to at least March 17th or more, the way then you could take advantage of that is you could at least get that discounted price in the synthetic market. In other words, you could go buy the stock out now or in the synthetic market for $7.27, or you could use the synthetic market to buy it at a 4.7% discount. So really, that's, as a retail customer, that's the only way you could really, take advantage of that. Remember, you still have to have a bullish outlook. And usually when it's hard to borrow like this, that means the demand to borrow and short the stock is high. So something could be up there, because when people are willing to pay to get short, they're probably looking at some data, some information that they're convinced that the stock is trading at above a fair value that they're willing to even pay to get short. So you keep that in mind, all right? You got to keep all that stuff in mind when you're looking at these screeners, all right? That doesn't necessarily mean that the shorts are going to be right, or the people, it just means that that's what the markets are indicating, all right? So let's take a look at a different screen. So let's give it a best discount, or the highest discount by stock, just to filter it out and we could get some insights here. Okay, so this will look at each stock and find what is the strike and the expiration offers the highest discount, all right, for each of the stocks that meet this list. Obviously, not every stock has a discount, but this is the ones that meet this list. And one thing to keep in mind is that if it has a dividend, in it, then it could mean that it's not necessarily at a discount. It could mean that our dividend forecast is different than the market's dividend forecast, because a dividend will make those calls lower and puts higher, right? So we are putting in our estimated dividend. If our estimate is different than the market's, that's why we put this check in. There is a dividend in here that will impact it too. So that's another thing to look at. Are the markets pricing in a higher dividend, and what dividend are they pricing in? But let's take a look at, here's AMPX. It's a $10.40 stock, but doing the synthetic in April, so 151 days to go on a 12.5 strike, you're getting a huge discount of 27%. Basically, this is the synthetic price. This is in the options market. This is the spot price. So you could see a huge difference, right? You still want to go in there and take a look if there's maybe some kind of a corporate action in there as well. So you do want to do due diligence. Why is that the case? Or maybe just the stock is very overvalued. You know, that's what things you have to look at. But here we go. In April, I'm going to click on that. So here we are in April, right? And what's going on here? So here, the call, 7.5 strike. The call is offered at $3.40. I'm clicking on that. All right. $3.40 over here. Ooh, hold on. I just changed the price. Let me leave it at $3.40. Okay. And on the put, I could sell it for $1.10. So let's click on that. Calculate that. So what happens is I'm paying $2.30 for that spread. I'm paying $3.40, collecting $1.10. It's going to cost me $2.30, right? $2.30. You know, let me redo. Hold on. Started messing with the prices. Let me do that again. Okay, $2.30, right? And if I add $2.30 to 7.5, right? What's that? $9.80, $9.80. But it's trading right now $10.40. So at expiration, if the stock does not move, right? If the stock is exactly at the same price as today, $10.40, right? What will happen is the puts that I sold expire worthless. The calls that we bought will be in the money, so I get exercised on it. In effect, I'm buying the stock at the 7.5 strike, plus I paid $2.30. So the total cost will be $9.80 for that stock. And if it's at 10.40, you could see that, right? That's a big discount. Hold on, was I looking at? Let me just come back. AM's, which one was it? APX. That is the 7.5 stock. Strike. Okay, so hold on. Right, so that's what's confusing. This is very wide. This market is really wide here. $1.10, 480, 250, 340. So I think that this is $2.30 credit. So that's another thing to be careful. Like, this is a very, very wide market. 90 cents on the call, and you know, you got $3, over $3, $3.70 in put. So you got to be even more careful here. Sometimes these markets are really wide. So even though it is at a deep discount, this is very wide. You could probably get away with not even paying anything here. You know, you could probably buy this at 3, sell this at 3, right? At the 7.5 strike. So that's another thing to be careful here, because this market is very, very wide. But even the bid to offer, buying on the bid, selling the offer, you could see that this is a big discount to the spot price. All right. Now, of course, you know, that doesn't mean you should go out and do it, right? That's not what it means. The data is just showing you that that's what the current market is doing. That's what exists. Like, here's a recognizable name, Beyond Meat, right? So this is Beyond Meat, BYND. And we could see here, they're also offered at a big discount. So let's take a look at that. Beyond Meat over here. I'm going to click on this and go to May. So we see that the stock is 1328, 1340, something like that. So what will happen is, here's the 10 strike. Let's do it on the 10 strike. If I buy the 430 call, sell on the 10 strike, 246 put, calculate that. Synthetically, you know, it's $1.84 plus The 10 strike is 1184, but the stock itself is 1325. And what this is doing is reflecting that the market's belief is that, that there are short sellers out there willing to pay in the spot market and in the synthetic market to get short. But if you disagree and your outlook is different, well, this is an opportunity for you to buy the stock at a discount to the spot price using the options. Okay. You still have to have the opinion that I think they're wrong and the stock's going up. All right. But that's kind of where the synthetic market is, how to use it. So in other words, no way for you to arb this, right? There's no way to arb it. So it's not like a risk. There's no riskless profit here. And this is also an indicator that, hey, something might be wrong with the stock valuation or stock, because there are players out there willing to pay a fee, to get short. Basically, they're saying, even with today's stock price, it's so overvalued that I'm willing to pay extra to sit on a short. Okay, so that's the synthetic long stock. I don't think I have enough time, Will, to go on to the other options chain. So I might stop here if there are no questions.
All right. Well, we did have a question I was going to send it on to you. It's more of a development question. A newer Chameleon who's been on a few times, Ivica, asks, hi, I have a question. Is it possible to add this, I guess, short interest column to pre-market analysis window? It would be great information like that while going through the pre-market movers. Do we have
say that again?
He's asking, is it possible to add a short interest column in the pre-market analysis?
Right. So I get this. I get questions about short interest a lot, and I think people don't realize what they're actually looking at when they look at the data short interest. I will discuss it maybe more.
We'll do it Monday.
But well, yeah, let's do it Monday. But I think that there's a lot of misconception with what actually you're looking at when you're looking at short interest, because the assumption is there's if it's 20% short, that means right now there are positions out there that are short, are betting short on the stock, with 20%. But that's not really what's going on. Okay. And it's important to understand, because I think people who are looking at these short interest data, first of all, they don't understand from what dates this is coming. Okay. They don't realize one thing is how far away it is, from what dates. And it doesn't necessarily mean that the short interest is representing a short outlook on the stock, because these could be tied to derivatives. And when it's tied to derivatives, they don't necessarily have a short, they don't have a short outlook. They're just hedged against a position, an overall position. So, I'll talk about it more, but it's not what I think a lot of people imagine what it is. And if you're using it in a way where you think this is what it is and it's not, then you're just not, using it appropriately anyway. But I'll talk about it more on Monday. Okay.
Awesome.
But,
and the last question was from Mo. He had asked, what's the best screener to find calls that are being sold into the market?
Best screener to find calls that are being sold into the market?
It says, what's a good screener to filter for see who is selling calls? Obviously, if they're sellers, they're buyers. So I would think if someone thinks they're selling calls, there's heavy call activity and volatility.
Yeah, I think you would have to see, right? maybe I could take a look at some screens and show you maybe like what I think you might be looking for, but we'll take a look at that Monday too.
All right, perfect.
Yeah.
Awesome job, Dima. I'll see everyone next Monday. Everyone have a great Thanksgiving. Thanks for everything, Dimitri.
Yep. Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you guys Monday.
All right. Trade and peace communities. Have a great week. Enjoy your turkey day. Have a good trading day today. And trading today, tomorrow, and Friday, right? Is Friday a half day?
Yeah. I think Friday is a half day.
Yeah.
I think so. I believe usually it is. Yeah.
All right. Have a great day, everyone.